Hello, and welcome to another episode of Moneyfy Mantra, where we speak with industry experts on various personal finance topics, which can help our viewers take informed decisions about their investments. Today, we have a public favorite topic, which is about investing in small cap funds. And to cover this topic today, we have Ms. Shaily Gang from Tata AMC. Shaily, a very warm welcome to Moneyfy Mantra.
Thanks, and always pleasure to be talking to the Moneyfy team. And thanks, Harsh. Yes, we can get on with the session today.
So just to give a quick introduction about Shaily, Shaily has been associated with Tata AMC for more than 4 years now. She has an overall experience of more than 18 years, where she has spent her previous stints at ICICI Bank, Royal Bank of Scotland, and HDFC Bank. So Shaily, without wasting much time, we'll start with the Q&A. So the first question which comes to everyone is, what are small cap funds?
Sure. Yes, let's begin. And I will at least share the screen, and wherever I think the slides will go with your questions, we will try and do that. So just give me a moment, please. Yes. Yes, what are small cap funds? The funds which invest majority of their investments, of their allocations, which they make to small cap stocks. And SEBI has recategorization, while recategorization they've mentioned the 65%. So those are the small cap funds which invest, minimum 65% into small cap stocks. It's important to understand how are the small cap stocks defined. So, to make it easy, uh, first to 100th company by market capitalization is the large cap. They are defined as large cap stocks. 101st to 250th company by market capitalization, that is the mid cap, that is defined as a mid cap stocks. And 251st company and below, that is defined as the small cap space. There were some discussions of defining the micro cap space also, but that is right now not completely done. Though there is a micro cap index, which is there present by NSE. There is a Nifty index. However, on the entire space below 251st stock by market capitalization can be covered or accessed by the small cap funds. So it's a huge space. There are fund houses like us. We do not go below the 1,000th stock by market capitalization, but so from 250th to say, let's say 1,000, the canvas is quite huge.
So yeah, correct. That we have a range of stocks to pick from the 251st company. So this brings another question, since the companies are small. Uh, so are these riskier companies to invest in?
So, yes, but of course, the risks come along with the advantages. Um, Risks, yes, because they can be highly volatile, and they tend to be more volatile than the large cap stocks. And their volatility comes on account of their size. So, because there is a low volume and the size is smaller, even a 5% price swing, and because the can actually make it more volatile, because it takes relatively lower trading volume to influence the price, and that is why they are quite volatile. Of course, they are less liquid as compared to large cap stocks. Large cap stocks are the bellwether stocks. They are, large companies, having stable balance sheets, and they are behemoths. But small cap stocks are, slowly getting and growing their way towards becoming mid caps and large caps, of course. So while they remain small caps, their liquidity is relatively less, and it could be sometimes challenging to, exit positions at specific prices, or without having an impact cost. So that's another risk for them. And the other risk is because usually the small cap valuations are derived from their growth potential, and they are supposed expected to scale their business models. And sometimes, these small cap companies, because they are still into a small earlier stage of their growth, so they could have very myopic geographical presence, or a myopic product presence, or a myopic customer base, or the customer base could be smaller. And that is why they could be more susceptible when there are business cycle or economic downturns on their, or business cycle fluctuations. So those are the risks. But yes, of course, high risk high reward is the space that it is. And the biggest advantage of small caps is their potential for growth. Of course, a large cap company cannot grow at the same pace and cannot keep growing by a very high percent, because they've already grown and they cannot outgrow the size of the economy. But a small cap is, company is still small, and you can have a larger growth rate into a small base. So that's the biggest advantage for small cap. Also, one more thing, as I said, I'm connecting this to the previous point, Harsh, that the area or the canvas for small caps is very, very large. However, and because it's large, it's not possible to cover, or do an analyst coverage for the entire 100% of the stocks with the same detailing, like how a large cap stock or the top 100 or top 50 stocks are covered. And obviously, then you have to go to find tooth and nail and go and pick those, do the bottom up picking and fish for those good small cap stocks. And that is where the potential for higher returns comes, because the information efficiency is not very, very smooth for small cap stocks, because the coverage is lower and the canvas is very large, and that is why the coverage is lower. So that is why it gives them again a potential for higher returns. And yes, individual small cap companies could be riskier, and they could have a potential probably to not do so good as compared to a large cap index or a large cap stock. However, when you put a portfolio of small caps together, and an with active portfolio with professional management, when you put that portfolio together, it is likely to produce better returns than the broader market. So, of course, growth and higher return potential are the advantages which balance out the risks, which we just spoke in the initial part of this question.
Correct. So, Shelly, when talking about small cap funds, most of the fund managers, choose, bottom up stock picking, where if they are, liking a particular idea of a, company, they go ahead and, invest into that company. So, is it true for Tata Small Cap Fund as well?
The bottom of stock picking, right?
Correct.
Yes, yes. So I would like to probably put out, this chart here. You can see the some data will also help us understand. As you can see, the number of stocks and the benchmark itself speaks for itself. Nifty Small Cap 250, the number of stocks, which is the tier one benchmark for us and for many of the funds. So if you see, the number of stocks in total are 250 here, whereas a small cap fund or any fund would have, any other Tata Small Cap fund or any other peer fund also would have between 45 to 60 stocks. They could have more also, 80, 90 stocks also, but a good number of stocks, is between 45 to 60 stocks. And uh, from there, you need to then construct a portfolio from this 250 stocks, or you could obviously have you have a canvas, a large canvas outside of this small cap index as well. So the first point is that the index itself is quite large and huge, which is 250 stocks. And as I mentioned at the very start of our conversation, that the overall canvas is too huge, let's say from 250th to 251st company and below. So you could have stocks or holdings in this fund which are outside of the benchmark also. And that is why it gives a lot of opportunity to the fund manager to do bottom up stock picking. And as you can see here, the texture, the DNA or the texture of the portfolio as well as this index is given here. So as you can see, the EPS growth by doing this bottom up stock picking, the EPS growth of the portfolio currently for FY23 EPS growth is showing as 30 is showing as 61%, whereas the index is at 34-35%. So and at the valuation level, both are similar in terms of forward PE. If you were to plot forward PE or Tata Small Cap or probably any other good small cap fund would be at a lower valuation and a better and attractive valuation as compared to the index. And all this, that is why gives a very good a platform or a very good space for bottom up stock picking. Also, if you see the concentration wise, if you see because the benchmark is too wide, you can see the top 10, top 20, and look at the top 50 holdings. Only 43% of the benchmark is covered, by the top 50 holdings. Um, and in case of the fund, it would be around 85-90% of the portfolio would be covered by the top 50. So too diversified benchmark it is, and the fund also balances out on the concentration diversification piece very well.
Correct. So, from an investor perspective, most of the investors, want to invest into small caps because obviously there's a higher volatility, but investors usually want to chase returns. So do you think investing into these, small cap stocks, is the mutual fund the best route, to go after these stocks? Or, some of the investors, usually focus on, going direct equity on some of the small cap stocks. So what's your message to such
Mm,
investors?
a very good question, and I would be wanting to answer this using two slides, Harsh, and I hope this is the answer is as is useful to the audience. First part of the answer would be that if someone wants to take a small cap exposure, then yes, small cap funds are a better route, because in other diversified funds or hybrid funds or any other solution oriented funds, you would not get a very a higher chunk of a small cap exposure. It could be 15, 17, 20%. But when you invest through small cap funds, you actually are able to zoom in into that segment and take advantage of that segment through the higher exposure to small caps. Second is, as I earlier mentioned earlier, um, the canvas is very, very large. The analyst coverage is small. The information efficiency is small. And because of all of that, if you see, there is a lot of difference in there's a lot of dispersion between the returns, and difference between the average and the minimum returns. If you see, the dispersion is very, very high in case of a small cap 250 index as compared to, let's say, Nifty 50, Nifty 100 or a mid cap 150. And here we have taken the dispersion between the average and the minimum returns. If you were to plot this for the top performers and the bottom performers, the dispersion would be very high. So let's say somebody who's directly going and investing into stocks, it's possible that there's a high probability that the person could go overweight on the wrong stock. So unless and until the person is professionally involved into studying each and every company, each and every small cap stock, unless the person is doing that, uh, you know, then there is a high chance that his calls might go right. Otherwise, there is a high probability that investors might go, overweight on a stock which is, which turns out to be not a great performer or not a great stock in hindsight. And going overweight on that not so great stock in hindsight would impact the overall portfolio very badly. So it's important that you go through the professional route, and while you go through the professional route, depending on the risk profile and the risk taking capacity, the volatility capacity, one should decide the allocation percentage for a pure small cap fund, I would say. Yes.
So, Shaili, one more thing. I think, most of the investors, as you mentioned, there's an information asymmetry in at least the small cap or the micro cap space. Would do you guys get a chance to meet the management, of some of the small cap companies, where it's very difficult to analyze the public data and make a decision, and where meeting some of the management personnel does help.
Yes, 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 absolutely, Harsh. Our investments team is continuously meeting, and they keep meeting the management of the small cap companies. In fact, all companies in the universe, and it's important to meet them to know what the management is thinking, what the promoters are thinking, the corporate governance bit, and how they are allocating capital, and whatever they are talking every quarter, is it coming out in the quarterly numbers which are being announced. So that mapping also, the fund managers are able to do, and by continuously being in touch with them, what happens, and especially our small cap fund manager has been telling us, and this is what I would like to highlight here, is that understanding the company, understanding the stock, and deciding to invest early, buying in early into that stock, and not waiting for the market consensus to come in, is where our fund manager is able to enter at a good price point, and such a price point that reasonable returns and good returns can be expected from that point onwards. And that call can be taken of buying early call can be actually taken only once you meet the management and you are in touch with them and you keep that trajectory on. Because in case of small caps, the biggest winner can be when you buy in early before the market consensus builds up, and then slowly the market realizes the potential of the company that you are already there present, or you're already overweight on, and at a very very and you bought at a very very a lower price than now what the company is starts to trade at as the market consensus comes in, and as the market also is ready to pay a higher multiple for that same earnings. That also happens.
Correct. So I think one data which I was analyzing, the smallest of the small caps, or the largest of the small caps, have been now. So for example, previously, I think 5 years back, the mid cap stock would start from around 10,000 crores. It's
Yes.
now, I think the average market capitalization of the small cap universe itself is around 9,500 crores.
Oh,
So would you be able to give us more sense how small are these small cap companies, or have they turned huge?
yes, yes, Harsh. So, to your last part of the question, have they turned huge and how have they moved? How has time played on the market capitalization? So, just to mention that point, in 2007, the 250 market capitalization of the 251st stock was at close to 3,000 crores, and as of 2022 end, it is 16,500 crores. So obviously, yes, the small caps are small caps, but the band of market cap has moved and they are also growing. So the market cap of 251st stock now is much, much higher than what the market cap of 251st stock was in 2007. That's one. That's the journey. As on date, I asked one of my team members to plot that what is the market cap of 250. So this number would be taken from the previous 6 monthly average, and that's why it's 16 and a half, and this would be from the latest data. So that is why if you see, so between 16 to 17,000 crores is the market cap of 251st stock. As you go down the value chain, the market cap value chain, you see, so 500th stock is about 5,200 crores. The 750th stock is about 2,100 crores, and the 1,000th market cap stock is about 1,100 crores. So yes, they have grown. And as on date, this is how, with a gap of 250 stocks, this is how the market cap flows down to the value chain.
Yeah, so I think small caps as we approach them, are turning to be kind of mid caps and a more stable category of stocks which are now invested into mutual funds. So the next question is on the the psyche of the investors. A lot of customers, when we see and see their portfolio, they have a large allocation to small cap funds. So what's your message to these customers who have over allocated to a small cap fund? What is the optimal allocation an investor should put across these small cap funds?
So yes, an aggressive investor, obviously, for an aggressive investor, maybe 85% of the portfolio would be equities. Let's start from there, 85-15, because 10 to 15% people would want to have, as emergency funds or a debt portfolio. And that's why 85-15. And if 85, within that 85, you can allocate about 25 to 30% to a small cap segment, not more than that. Also, because you need to realize that there are other categories. So maybe you can cap it at 25 because there are other categories like large and mid cap, multi cap, who have small cap allocations. And obviously, there are phases in the market. So if in a broad based economy and market phase, you would see the allocations towards mid and small caps being increased by the fund. So even these categories would have, the other categories would have higher allocations. So a pure small cap fund, you could look at between 25 to 30 for an aggressive investor. And then other categories would also contribute some bit, 5-7% of small cap allocations, overall to that portfolio. And for a moderate investor, again, maybe from the 50-50 uh, equity debt allocation broadly, you could look at again, 15% going to small caps, pure small caps, and 12 to 15%. And for a conservative investor, probably if there is some equity allocation, probably not more than 5% can go, or through multi-cap also for a conservative investor, small allocation to multi-cap fund, or through any BAF or any other category of funds, hybrid category, which are lower volatile. Even those have small cap allocation. So a conservative investor can look at small cap allocations through those funds also. So at a portfolio level, overall, ideally, it should not go beyond 5 to 7%. That's how I would put it.
Sure. So, we've seen that, now, talking about the sectors these, small cap funds are able to invest into. We've seen, large cap funds or, the Nifty index, a large part of the, index and the funds are invested into BFSI as a sector. However, when, as we come down into market capitalization and companies, the allocation to one particular sector sort of decreases drastically, where we have then the funds are usually diversified across multiple sectors. So is it not beneficial for a small cap investor who's investing into a small cap fund where he's getting exposure to a broader pool of sectors than a large cap fund?
So I would, okay, again, two parts to this. So one point which I would like to highlight is that these are the basic industries, the sub parts of the sectors, Harsh, that's how we put it. These are sub parts of the sectors, the larger sectors, and these are unique to small caps, exclusive to small caps. So you have a large number of, subsectors or sectors also, which are very, very unique to small cap. And if there is growth being seen there, if the economy is broad basing and there is growth being seen there, then they the only way to access those sectors and subsectors is by taking exposure to small caps. So uh, there are some sectors which are only present there, and obviously you will need to go there. That's one part, because you don't find many of these sectors in large caps, and even not even in mid caps. That's one. One more point. So yeah, this is like the sectoral breakup of the Nifty Small Cap 250, where financial services, cap goods, healthcare, IT, you can see the weightages. And small cap and our small cap specifically, and the space is such that it should have and it will have, and our fund of course is a complete total true blue bottom up stock picked portfolio. So when you do bottom up stock picking, the sector weightages are incidental to which stocks you like, the fund manager likes, or what stocks he goes by. It is not a top down thing that okay, we need to allocate this much to this sector. It's not a, let's say, a business cycle fund which has a more top down approach. Now when you have a bottom up approach, you add stock by stock, and the sector weight is incidental to what all stocks you have picked up. In that process, it is possible that the sector deviation from the benchmark could be higher. So usually in a diversified fund, you would have a 3 to 5% sector deviation happening from the benchmark sector holdings under at the sector level. Beneath that, the stock holdings could be quite different. But I'm saying at the sector level, a usual diversified equity fund would have 3 to 5% sector deviation. However, in a true blue and specifically a small cap fund, you could have a 8 to 10% sector deviation also. Like for example, in financial services, I think we hold 9 to 10% only, whereas the benchmark is at 20%. In services, for example, we you can see there's 4% allocation in the benchmark, but we have a huge allocation here because there are a lot of logistics and transportation stocks which we've taken exposure to, we are overweight on, as in the fund is overweight on, and has worked very well for the fund. In case of FMCG also, there is a one particular subsector which is beverages, where there is one stock which now has grown to about a good 4 5% of allocation, and that itself is contributing to the fund's returns. And we are quite overweight as compared to this allocation of FMCG which is being seen here. So as I said, the sector weightages are incidental to what stocks the fund manager likes in his bottom-up stock picking process, in the process of meeting the management, in the process of doing his fundamental analysis. And yes, largely, obviously, the sectors are covered, and you do have a diversified portfolio through that active management of the small cap space for sure. But the deviations from the benchmark could be there, is the point I'm making.
Correct. So I think, moving to the next question, it's about the mode of investment which, most of the investors now want to choose, which is SIP. So, should an investor who is wanting to, start investing into small cap funds only, look at SIP as a route, to start taking exposure to small cap?
Uh, yes, I think SIP is a great idea. SIP is it's a simple, but it is an amazing feature to a fund, and which can really enhance the experience and the returns both. See, small cap space is quite volatile. We discussed this at the start, and when you have more touch points every month coming in, you might end up reducing the volatility part of it. Having said that, if you just see the return part of it in a 3 year return, and it also depends on what period you are taking in a point to point return. Because you are taking just 2 dates for a 3 year point to point return, you are taking 2 dates, but for a SIP return, it is a journey.
Correct.
So sometimes at one point in time when we look back, 3 year or 5 year lump sum, it could be lower than a SIP return, or it could be higher, because it depends what has been the 5 year phase that we are looking at. So as you can look at this is a sample, it's an illustrative this thing, actual returns, but because we are looking at one point in time, the data as on today, 31st July, let's say, 31st August data, that is what we are looking at. You can see in 3 years bucket, the period bucket, the lump sum is the winner. Since inception, uh, bucket, the SIP is the winner because it is at 31%, whereas the lump sum return is at 24%. And it's a huge difference. A 6% CAGR is a huge difference. And again, in a 1 year, the SIP is a winner. So that's how. But the other part of this is your income, the investor's income, or the investor's you know monthly earnings are also periodic. So if they are periodic, then they can also be invested only periodically. And if they can be invested periodically, uh, a volatile fund like this, it makes a lot of sense to allocate monies every month, and start a SIP so that your money gets allocated every month, and every month's price level is being captured by this volatile category of small caps.
Correct. I think with the high volatility in this space, it makes more sense to go after
SIPs.
the SIP route, and it usually helps in rupee cost averaging. And I think the experience of the investors is much better when they come through an SIP, because we've seen that customers, when they enter in any one point in time, and there's some hiccup in the market, uh, you know customers, or the investors don't like their portfolios to go down at all. And if they see a 10 or 15% downward
Yes,
return, the experience is not that good. And then then they have a permanent bias in their mind that the small caps are not the one which help them
sure.
generate returns.
Yes, yes, yes. So it gives, an encouragement to the investors to not exit the game or exit the market, and to keep them going when their investments are spread out across multiple entry points. Yes,
So yeah, I think Shelly, we have completed all our questions for the day. Thanks for joining us. I would request you to just unshare the screen.
sure.
Yeah, so
Yes.
thanks Shelly very much for the session today. I think it was explained in a very detailed, yet simple way. Uh, you have any final remarks for our investors, who are looking forward for the small cap funds?
Yes, no, it was nice talking to the Money5 investors and the Money5 team, and we enjoyed putting some of the data that some of a couple of slides couple no 3 or 4 slides we actually put in afresh for this session, and we enjoyed doing that. The questions were very interesting. Thanks, Harsh. And yes, I think this is a great space. So zoom in into this segment through a SIP route, and and whenever you're looking at this segment, please look at it from a 7 to 10 years perspective, and you should be amazed by what kind of wealth creator this segment can actually be. So happy investing, and
Correct.
continue to invest.
Yeah. To all our viewers, who are planning to start their investment journey in the small cap fund, you can download the Moneyfy app by clicking on the link given in the description below, and start investing through SIPs in minutes into the small cap fund. Further, if you have already invested in some of the other mutual fund platforms or distributors, if you in case want to consolidate all your investments, you can do so on Moneyfy, where you can track all your external investments as well. And to watch more such videos, please follow us on Facebook and Instagram, and do subscribe to our YouTube channel. Thanks everyone for watching this video till the end. Thanks Shelly for doing this session today.
Thank
Thanks,
you.
thanks.
Thanks, Harsh and team. Thank you, Manify. And thank you, all investors.